Hello, my name is Scott Carruthers from Foolproof Bookkeeping, and today we are looking at an alternative approach to increasing your menu pricing. We'll assume that you've already done some menu engineering, you've already done whatever analysis you need to do, whether it's about your labor, your cost of goods, both, anything else, and you've determined that you need to raise menu pricing, but you don't want to do just a wholesale, let's raise everything by 5% or 10%. We're going to look at how to fine tune this information a little bit, and we're just going to dig into another approach. So all I've done here is on the left-hand side, I've listed out all of the items. So you can do this with pen and paper if you're not comfortable with spreadsheets. Spreadsheets obviously just make the math a little bit easier because you can enter formulas, drag and drop, but do whatever feels right for you. Take your item, whether this is a beverage menu or a food menu, you might do a separate breakfast, lunch, dinner menu, if you have a late night menu, whatever your type of service is in your restaurant or bar. Pick the menu that needs to have price changes and list out everything that's on it. Pretty straightforward. Right beside that, you're going to put in how much you sell it for. Whatever the price is on your menu, boom, there it goes. The next column over is how many of each of those items you sold in a given period. I'm going to talk about it from the perspective of 1 month here. So you might want to look at this and say, what we sell last month. You might want to say, what was the average of our sales over the last 6 months? Whatever makes sense in your particular situation, depending on seasonality or where you're at. I like to just look at the last month because we're talking about increasing menu prices. And if you have a fairly steady business, that should work out fine. If your business, for whatever reason, fluctuates highly in what sells in what month, then you're going to have to do a little bit more work to figure out what that average number is. This column here, our sales, is really simple. It's how much you sell an item for times how many you sold in that period. And so we got $4,675 in sales of item number one in this month. Add all those things up, we get down here to $48,995. I want to stress here, it doesn't matter how much you sell. You could sell $20,000 a month, you could sell $250,000 a month. The process is exactly the same for everybody when you're looking at menu prices increases. So what we want to do is evaluate how much we need to increase menu prices by. So for this example, I'm going to assume that we've been able to hit a 30% cost of goods on whatever this menu is. And we've been able to hit that for a few months. We feel comfortable with it. We're having trouble just clicking over that last 2%. And we know that we need to hit that 28% because we've done the CVP analysis, the cost volume profit analysis. We've done our forecast. We've done our cash flow forecast. We've kept it rolling. We're upgrading it every month or every quarter or semi-annually, however often you do it. And we're saying we need that extra 2% in order to have a positive cash flow for the next 12 months, to have the kind of profit we need to continue to operate a successful business and to feel good about what we do. So what we need to do is hit a 28% cost of goods. And that's why we're doing this menu price increase. Again, you might be doing it for any number of reasons. I'm just focusing on this one for our example. You could be doing it for labor as well. So you probably already know, if we're talking about cost of goods, how much you spent in that period that we're evaluating. So you've got your cost of goods and you've got your sales, and then you figured out the percentage, and that's how you know you're off. Another way to look at it is if for some reason you only knew your cost of goods percentage and not the dollars you spent and your revenue, you could just go into this little formula here, and you're going to say our cost of goods was 30%, so 0.3 times what our revenue was, and we spent $14,699 on the ingredients that we used in order to make this $48,995 in sales. Now, again, you probably have this number already as a dollar figure from your profit and loss statement, so you just pull it straight from there and plug it in. We want to hit a 28% cost of goods, but we're doing it, remember, on what we've sold. So we're trying to imagine, this is what we sold last month. We hit a 30% cost of goods. If we sold the same number of items, the same sales mix, what would the total sales dollars need to have been in order for that cost of goods to be 28%? In other words, this $14,699, we're going to spend the same amount of money. We're going to buy exactly the same ingredients. What do our sales need to be in order for that purchase amount to be a 28% cost of goods? So we just go equals, whoops. There we go. I'm distracting myself. So equals are what we spent and then divide it by 0.28, $52,495. So spending $14,699, if that's going to be a 28% cost of goods, our sales, our revenue needs to be $52,495. So all we want to do now is evaluate how many dollars difference it is between what we needed in order to hit our target versus what we actually did. So simple equation, it's what did we need minus what did we actually do. And so we need to make up $3,500 in revenue here. So that brings us to the actual finessing part. And so we want to examine the menu, and you're going to need to use some objectivity here. I mean, we're using math to help us get there, but restaurants and bars are businesses run by people, patronized by people. And so there's objectivity involved, and people make choices based on their perceived value, based on how something makes them feel. They come to your establishment for an experience, and probably not because you have the lowest price on something. You're not Walmart. I mean, maybe your business is like Walmart and you're probably not watching this video. So what we want to do is take a look at what our items are, and then we want to start thinking about where can we tolerate some increase in prices. So item number one, although it's your lowest price item, maybe that's as high as that item can go based on your competitive landscape. So you don't want to touch it, even though you've got good sales in it, and an increase there would help a lot. Item number 10 is your highest priced item. It's also your lowest quantity of sales. So whatever that item is, maybe people who love it really love it, and they know it's expensive and they don't mind paying a bit for it. So you're going to see if you can pump that up to $29. So what we want to do is say, what is the difference if we had sold last month those same things, the same quantity, but at a higher price? How much would we have made? And so it's just, what's the new price? That's the old price times the quantity sold. And the reason I put that in a formula is just so that as we work our way through this, if we decide 29 is maybe too high, let's go to 28, I can just change that number and it updates for us automatically. So you can, again, do this by hand with a calculator and a pen. It's no problem. So now we've recovered $450 of the $3,500 that we need to make up. If we accept that this is a price that will not affect our sales mix, that people who are buying this are going to spend the $29 instead of the $26, they don't care. That's what they want. What we want to do is get to a point where all of these things are going to add up to the $3,500. And then we know that we're ready to just go ahead and make those price increases. So what else can we do? Maybe this $21 item, we're selling a lot more of it. Maybe we could sell it for $23. Maybe whatever it is, maybe your competitors are selling a similar product for $22, but you do a better job of it. I mean, you sell quite a few of them, and your customers are happy, and they're not going to flinch over the dollar difference. And so again, we take a look at what is that difference going to be in terms of dollars. So we're raising the price by $2 on 235 items sold. That gives us another $470 in revenue. So those two increases already put us up to $920. And you just keep working your way through this. Now, one thing I want to stress here is that it doesn't all have to be big jumps. So this $2 jump here right now at $23 brought us $470. What if we added 25 cents to that? $528.75. So that 25-cent increased price on that one item added another almost $60 in revenue to our monthly sales. So small changes with a large volume of sales can have a big impact on what you're trying to do. You just keep working your way through this. Just keep adding whatever, thinking about where you can massage prices, what your clients will tolerate, and be pumping it up until this number starts to match this number or gets close or makes you feel reasonably comfortable. Then when we do this next month, you're going to, if you have the same number of customers, you're going to have a similar sales mix and you're going to have that higher revenue. Your cost of goods is going to go down. Your labor cost is going to go down. Sales are up. Hopefully you're hitting your profit targets. Hopefully you're hitting your cash flow metrics, and hopefully life is good so that you can run a business that you're proud of, that you enjoy running, that makes you money, and that your customers love and want to keep coming back to. The most important thing to keep in mind when you're analyzing a menu price increase using this method here is, what do you do well? What do you do better than your competitors? and where will your customers see the value in what you're doing so that they're purchasing based on an emotional reaction, buying something on value as opposed to buying something on a practical dollar standpoint reaction. If they're looking for the cheapest thing and you're raising prices, you've got a problem. But if your customers really love this item number 6, because you sell 250 of them a month, and you think they can bear to spend $2 or $3 more on it, and it's not going to affect anybody, your customers are still going to leave and they're going to say, I love that so much, and they're still going to tell all their friends, and they're still going to come back, and they're not even going to notice the price increase. Then those are the items that you increase. And that's the whole point of looking at this, is saying item number 1 is price sensitive. It's already high. If we put it up again, we're going to start to upset people. They're maybe not going to come back. They're definitely not going to order that item. And they're maybe going to start talking about how expensive we are. So this is where the objectivity comes in, and you need to understand your customer's journey, and you need to understand what they're going to accept in terms of your price increases. Thanks very much, and I hope you enjoyed this video, and I hope it was useful for you, and I hope you have great success with your business.